Many people look at the Middle East today and think they are watching a direct confrontation between Iran, Israel, and the United States. That is the easiest way to see it. It is also the most dangerous way to see it, because on the real chessboard, where gunfire is only the outer layer of the story, the side being squeezed the hardest is not Tehran, and it is not Tel Aviv. It is Europe. That is the part of the iceberg below the water. The Middle East is only the stage, the audience being dragged into the play, the ones being forced to pay for every act, are the industrial economies on the other side of the Mediterranean, and somewhere in the darkness behind that stage, there is one country that does not need to fire the first shot, yet can still smile quietly every time oil prices climb another step. That country is Russia. If you only read headlines about airstrikes, sanctions, and retaliation, you will assume this is a conflict between obvious enemies. But great power politics has never run on emotion. It runs on interests, on costs, on pipelines, on ports, on tankers, and on energy contracts worth tens of billions of dollars. Once you understand that, you begin to see why some states can stand outside the battlefield and still gain more than those who are directly involved in the fighting. Russia did not enter this game yesterday. The bond between Moscow and Tehran is not a temporary reaction. It is the result of years of military cooperation, years of shared battlefields, years of testing each other's reliability, and years of building connections that were never meant to be displayed too openly. When two sides have operated side by side in the same regional theaters, they exchange more than promises. They exchange experience, technology, and the shared understanding of who the real enemy is. The most unsettling part is not what is said in public. It is what can be denied, yet still leaves traces behind. The drones, the jamming systems, the fragments left behind after strikes. All of it forms a picture clear enough for any serious observer to understand that this is no longer a matter of isolated local capability. Behind attacks on energy infrastructure lies the thinking of a network that had already been prepared in advance. And the targets are not random. Strikes against refineries, export terminals, gas routes, and critical links in the energy supply chain are not designed merely to create military headlines. They hit the one thing the global economy fears most: supply disruption. In a world where oil and gas still function like blood in the arteries of industry, the moment a blockage appears, the entire body begins to convulse. When supply in the Middle East starts to shake, energy prices do not respond emotionally. They respond according to the market's survival instinct. Every report of disruption, every image of an oil port under threat, every sign that a strategic maritime choke point could be blocked, is immediately converted into pressure on prices. And once prices rise, the first actors to feel their breathing tighten are not always the producers. They are the economies that must import energy on a massive scale. Europe belongs to that group. After years of talking about reducing dependence on Russian energy, the continent has still not truly escaped Moscow's shadow. Old supply routes were broken. Alternatives became more expensive. Receiving infrastructure remained uneven, and industrial demand could not be turned off by political slogans. Europe can change its language quickly, but changing an energy structure is a project of years, sometimes decades. That is why every new shock in the Middle East pushes Europe back into a corner. On one side stands the need to keep factories running, transport moving, homes heated, and the civilian economy functioning. On the other side stands geopolitical pressure, the desire to reduce reliance on Russia, and the hope of surviving on substitute supplies. But in the real world, when energy prices surge, morality often gives way to the monthly bill. That is precisely why Russia can remain so calm. It does not need to win every diplomatic argument. It only needs the global market to become unstable enough that energy routes once treated as politically untouchable begin to reappear as practical solutions. When European industry faces soaring costs, when households are hit with rising bills, and when inflation pressure starts to return, even the hardest rhetoric begins to soften. Within that logic, the longer Iran keeps the confrontation alive, the more room Russia gains. Every new escalation in the Middle East acts like an invisible hand tightening its grip around Europe's energy throat. Moscow does not need to stand in the front line. It only needs to remain in the position of a supplier that still holds part of the key. And while others are consumed by crisis management, Russia's strategic value rises almost automatically. But the story does not end there. If Russia sees this crisis through the eyes of an energy exporter, The United States sees it through the eyes of the state that holds global financial power. That is the point many people miss. They argue about who is right, who is wrong, who started the fire, and who deserves blame. But major power centers rarely look at war through a purely military map. They look at it through a balance sheet. When the world becomes unstable, one reaction tends to happen almost automatically. Capital flees risk, then searches for a place capable of absorbing enormous amounts of money in a very short time. In a panic, money does not go looking for justice. It goes looking for shelter. And in the world we live in today, the largest shelter is still the United States. Imagine global capital as a fleet carrying tens of trillions of dollars. This is pension money, central bank reserves, investment funds, private wealth, and the assets of financial elites. When the storm hits, those ships cannot anchor in a harbor that is attractive but shallow. They must head for the only place deep enough, wide enough, and liquid enough to swallow enormous sums without collapsing under the weight. And for now, that harbor remains the United States Treasury market. This is a form of power that is not flashy, but extremely dangerous. When the whole world wants the safety of US treasuries, it must first accumulate US dollars. The greater the panic, the stronger the demand for dollars. The stronger that demand, the more powerful Washington becomes. The United States does not have to be perfect. It only has to be seen as the least risky destination in the eyes of global capital. That alone is enough to drain financial energy out of much of the rest of the world. That is why every time war escalates in a strategically important region, the dollar often strengthens, money exits risky assets, leaves emerging markets, pulls away from places considered more fragile, and rushes toward New York and American government debt. A crisis thousands of miles away can still turn into a direct advantage for Washington. Because in moments of fear, the entire world once again chooses to finance the United States. This is the deeper layer of the strategy. America is not only a military power, it is also the owner of the largest financial bunker on Earth. When chaos breaks out, it can benefit from its role as an energy exporter, benefit from global capital running into treasuries, and place additional pressure on industrial rivals that depend heavily on imported fuel. One crisis, several gains. That is not coincident. That is the architecture of power. Now look toward Asia. Japan and South Korea are highly sophisticated industrial machines, but they lack abundant domestic energy resources. For them, rising oil prices are not just numbers on a screen. They are direct wounds to the trade balance, to manufacturing costs, to household purchasing power, and to inflation stability. A single upward move in energy prices can trigger a whole chain reaction. Economies dependent on imports are always the first to feel it. China is not immune either. As the world's largest factory floor, Beijing needs a vast volume of energy to keep production running. When oil prices climb, exporters immediately feel the pain through higher input costs. Profit margins shrink, pressure on the exchange rate intensifies, and the broader growth engine faces a much harder equation. In other words, a fire in the Middle East can burn straight through the margins of factories located thousands of kilometers away. Europe suffers in a different way. After losing much of its access to cheap Russian gas, it has been forced towards supplies that are more expensive, more complicated, and less stable. If oil remains elevated, European industry loses even more competitiveness. That is especially dangerous for economies that depend heavily on energy-intensive manufacturing, such as Germany. An industrial base that is already fatigued cannot easily keep its footing while running through another wave of fuel price shock. So who is smiling? First, American energy exporters. Thanks to the shale revolution, the United States is no longer the country that trembles every time the Middle East catches fire, as it did in earlier decades. When oil prices rise, revenues for US energy giants surge. That money flows into corporations, into taxes, into jobs, and into headline economic data. The war may be happening elsewhere, but the financial upside can arrive in Texas or Oklahoma faster than most people expect. Next comes the American financial system. When the world rushes towards safety, Washington finds it easier to borrow. The US government issues more treasuries, and buyers keep showing up. It can borrow more cheaply, more sustainably, and under far better conditions than much of the rest of the world. That helps preserve its military machine. its fiscal flexibility, and its global reach, even as other countries are weakened by rising capital costs and rising energy bills. If you look at the situation coldly enough, the pattern becomes obvious. Russia uses crisis to increase its geopolitical value in Europe's eyes. The United States uses that same chaos to reinforce the throne of the dollar and attract global capital. The rest of the world pays the bill through higher import costs. Inflation, weaker currencies, thinner margins, and slower growth. No one in this game is acting out of pure generosity. This is where anyone still holding a romantic view of international politics starts to feel uncomfortable. Because the truth is simple: no ally is completely selfless, and no support is completely free. Every missile, every shipment, every diplomatic gesture, every hard-line speech, ultimately returns to national interest. In the game of great powers, morality is often just the outer coating. At the core, the calculation is always about advantage. So the real question is no longer who sounds right in a press conference. The real question is who benefits at the structural level. And if you answer from that angle, one thing becomes very clear. A prolonged Middle Eastern conflict creates two parallel levers. The energy lever destabilizes Europe and parts of Asia. The liquidity lever drives global money back toward the United States. One side exerts pressure through fear of fuel scarcity. The other side exerts pressure through fear of asset insecurity. That is the formula of power. Many people still assume power lies in weapons, in strikes, invisible retaliation broadcast across television screens. But weapons are only the most visible layer. Real power lies in who controls the throat of energy, and who controls the largest liquidity harbor on Earth. The actor that holds those two gates does not need to dominate every front line. It can sit still and still force the rest of the world to move according to its rhythm. In the current picture, the United States still holds the largest financial harbor. Russia remains an energy player capable of exerting pressure on Europe. And the Middle East, with all its instability, becomes the zone of heat intense enough to redirect both capital flows and energy flows across the planet. A fire in the right place can reshape the movement of both money and oil. That is why local wars can produce systemic consequences. The most striking part is that the public is usually shown only the emotional side of war. People see ruins, retaliation, outrage, declarations, and moral language. All of that is real. But behind that dust and noise, major power centers are calculating in terms of yield, energy pricing, trade diversion, and the degree of dependency their rivals can tolerate. They do not think like spectators. They think like accountants of power. And that may be the coldest truth of this age. The world may argue endlessly about justice, but below is a close English rendering, kept in a formal editorial voice and in short-spoken paragraphs so it remains clear and natural for narration and TTS delivery. Yourwhack, https://yourwhack.com/blogs/how-to/optimize-TTS-scripts closing parenthesis. If you watch this video to the end, you will not become rich overnight. You will understand how money, energy, and war are being used as levers to shape the fate of entire continents. And once you understand that pattern, you will be far less naive when facing the flood of headlines pouring across your screen every day. Many people look at the Middle East today and think this is simply a confrontation between Iran, Israel, and the United States. That is the easiest way to see it. It is also the most dangerous way to see it. Because on the real chessboard, where gunfire is only the sound on the surface, the side being strangled the hardest is not Tehran, and it is not Tel Aviv. It is Europe. That is the part of the iceberg beneath the water. The Middle East is only the stage. The audience being dragged into the play, the one being forced to pay for every act, is the industrial world across the Mediterranean, and in the darkness behind that stage, there is one country that does not need to fire directly, yet can still smile quietly every time oil prices climb another step. That country is Russia. If you only read headlines about airstrikes, sanctions, or retaliation, you will think this is a clash between direct enemies. But great power politics has never operated on emotion. It operates on interests, on costs, on pipelines, on ports, on oil tankers, and on energy contracts worth tens of billions of dollars. Once you see it that way, you begin to understand why some states remain outside the battlefield and still profit more than the ones doing the fighting. Russia did not step into this game yesterday. The connection between Moscow and Tehran is not a temporary reaction. It is the result of years of military cooperation, years of sharing battlefields, testing combat capacity, and strengthening ties that were never fully displayed in public. When the two sides stood on the same front in parts of the Middle East, they did not merely exchange promises. They exchanged experience, technology, and a common view of their adversaries. The most unsettling part is not what is said openly. It is what can be denied, yet still leaves traces. Unmanned aerial systems, electronic jamming technology, fragments recovered after attack. All of it forms a picture that suggests this is no longer an improvised capability. Behind the strikes on energy infrastructure lies the thinking of a network that was prepared well in advance. And the targets are not random. The attacks on refineries, export terminals, gas routes, and key nodes of the global supply chain are not only meant to create military shock. They strike directly at what the world economy fears most: supply disruption. In a world where oil and gas still function as blood in the arteries of industry, once a choke point appears, the whole body starts to convulse. When Middle Eastern supply begins to shake, energy prices do not react emotionally. They react through the market's survival instinct. Every report of disruption, every image of a threatened oil port, every signal that a strategic maritime route could be blocked, is immediately converted into upward pressure on prices. And when prices rise, the first side to feel its throat tighten is not the producer. It is the economies that depend on massive imports. Europe belongs to that group. After years of talking about cutting dependence on Russian energy, the continent still has not truly escaped Moscow's shadow. Old supply lines were broken. Replacement sources are more expensive. Import infrastructure is uneven, and the needs of industry cannot be switched off with political slogans. Europe can change its language quickly, but changing the structure of an energy system is a matter of years, even decades. That is why every time the Middle East becomes unstable, Europe is pushed into a dilemma. On one side is the need to keep factories running, transport moving, heating functioning, and the broader civilian economy alive. On the other side is geopolitical pressure, the desire to reduce reliance on Russia, and the expectation that Europe can stand on alternative supply. But in the real world, when energy prices surge, morality often gives way to the utility bill. That is why Russia can remain calm in a way that feels almost cold. It does not need to win on every diplomatic front. It only needs the global market to become unstable enough that the energy routes once dismissed as unacceptable begin to reappear as practical solutions. When European industry faces soaring costs, when households are forced to pay more, when inflationary pressure returns, even the toughest political declarations begin to soften. In that logic, the longer Iran prolongs the confrontation, the more breathing room Russia gains. Every new wave of tension in the Middle East is like an invisible hand pressing on Europe's energy throat. Moscow does not need to appear at the front line. It only needs to remain in the position of a supplier holding part of the key. And while others scramble to contain crisis, Russia's strategic value rises almost automatically. But the story does not stop there. If Russia views this crisis through the eyes of an energy exporter, then the United States sees it through the eyes of the power that controls the world's main financial shelter. This is the point many people miss. They argue about who is right, who is wrong, and who caused the chaos. But major centers of power rarely view war through a military map alone. They also view it through a balance sheet. Whenever the world becomes unstable, one near-automatic reflex appears. Capital flees risky places and searches for the one place capable of absorbing enormous volumes of assets in an extremely short time. In a panic, money does not look for justice. Money looks for shelter, and in the current global system, the largest shelter is still the United States. Imagine global capital as a fleet carrying tens of trillions of dollars. This is pension money, central bank reserves, investment funds, private fortunes, and financial institutions of every kind. When a storm rises, those ships cannot anchor in a small harbor. Even if it is elegant and well designed, they must rush toward the only port deep enough, wide enough, and liquid enough to absorb such a mass of wealth without collapsing. And that port, for now, remains the United States Treasury market. This is a form of power that is not flashy, but it is deeply frightening. When the entire world wants refuge in US Treasury securities, it must first obtain US dollars. The greater the panic, the higher the demand for dollars. The higher the demand, the stronger Washington's position becomes. America does not need to be perfect. It only needs to be seen as the least risky destination in the eyes of global capital. That alone is enough to drain financial strength from the rest of the world. That is why, whenever war escalates in a strategic region, the dollar often strengthens. Capital runs from risky assets, from emerging markets, from places perceived as more fragile, and pours into New York and US government debt. A crisis thousands of kilometers away can still end up reinforcing Washington's advantage. Because in moments of fear, the world once again buys American debt willingly. This is the deeper layer of the strategy. The United States is not only a military power, it is also the owner of the largest financial bunker on the planet. When turmoil erupts, it can benefit from its role as an energy exporter, benefit from capital flowing into treasury bonds, and impose pressure on industrial rivals that rely heavily on imported fuel. One crisis, multiple gains. That is not random. That is what power looks like when it is designed well. Now look toward Asia. Japan and South Korea are highly advanced industrial machines, yet they lack domestic energy resources. For them, a rise in oil prices is not just a number on a screen. It is a direct wound to the trade balance, to production costs, to domestic purchasing power, and to inflation control. Every increase in energy prices can trigger a chain reaction. Economies dependent on imports will always feel that pain first. China is not immune either. As one of the world's great manufacturing centers, it needs enormous amounts of energy to keep its production system running. When oil prices rise sharply, the input costs of exporters are immediately squeezed. Margins thin out, exchange rate pressure grows, and the broader growth machine faces a much harsher equation. In other words, a fire in the Middle East can burn through the profit margins of factories thousands of kilometers away. Europe suffers in a different way. After losing much of its cheap gas from Russia, it has been forced to turn to supplies that are more expensive, more complicated, and less stable. If oil prices remain high, European industry loses more competitiveness. This is especially severe for economies deeply dependent on energy-intensive production, such as Germany. An industrial system already exhausted cannot perform well when forced to run under feverish fuel prices. So who is smiling? First, America's energy exporters. Thanks to the shale revolution, the United States is no longer the country that trembles every time the Middle East catches fire, as it did in earlier decades. When oil is expensive, US energy firms earn more. That money flows into companies, into tax revenue, into employment, and into the broader economy. The war may happen elsewhere, but the financial reward can arrive in Texas or Oklahoma far faster than most people imagine. Next comes the American financial system. When the world rushes towards safety, Washington can borrow more easily. The US government issues more debt, and buyers are always there. It borrows more cheaply, for longer durations, and under better conditions than almost everyone else. That helps sustain its military apparatus, its fiscal system, and its global influence, while other countries are weakened by rising capital costs and rising fuel bills. If you observe all of this coldly, a very clear pattern emerges. Russia uses the crisis to raise its geopolitical value in Europe's eyes. The United States uses that same chaos to reinforce the throne of the dollar and attract global capital. And the rest of the world pays the bill through import costs. Inflation, weaker currencies, higher production expenses, and slower growth. No one in this game is acting selflessly. This is the point where anyone still holding a romantic view of international politics will feel uncomfortable. Because the truth is simple: no ally is completely selfless. No support is completely free. Every missile, every shipment, every diplomatic move, every hardline statement eventually comes back to national interest. In great power politics, morality is often just the outer coating. The core is almost always advantage. So the real question is no longer who sounds right in public. The real question is who benefits at the structural level. And if you answer from that perspective, one conclusion becomes hard to ignore. A prolonged conflict in the Middle East creates two parallel levers. The energy lever destabilizes Europe and Asia. The liquidity lever drives global capital back to the United States. One side controls fear over fuel. The other controls fear over assets. That is how durable power is built. Many people still assume power lies in weapons, invisible strikes, in the retaliation we watch on television. But weapons are only the most visible layer. Real power lies in controlling the throat of energy, and in owning the deepest liquidity harbor in the world. The one who controls those two gates may never need to stand on the front line, and yet can still force the entire system to move in rhythm with his design. In the current picture, the United States still holds the world's largest financial harbor. Russia still remains an energy player capable of putting pressure on Europe. And the Middle East, in all its turmoil, becomes a heat zone intense enough to reshape the behavior of global markets. A fire in the right place can redirect both money and oil. That is why local wars can end up producing systemic consequences. What is most striking is that the public usually sees only the emotional side of war. People see destruction, retaliation, and moral slogans. Those things are real, of course. But behind the dust and smoke, the major power centers are calculating yields, oil prices, rerouted trade, and the dependency levels of their rivals. They do not act like spectators. They act like people auditing assets. And perhaps that is the coldest truth of this era. The world may argue endlessly about justice, but money does not argue. Money flows toward the safer destination. Energy does not argue either. It flows where the valve is allowed to open, when both capital and energy are directed by a small number of power centers. Then the rest of the world, whether it wants to or not, lives according to the rhythm they impose. That is why the important thing is not memorizing each breaking headline. The important thing is seeing the structure beneath those headlines. When the Middle East burns, ask who is losing supply, who is selling at a higher price, who is absorbing more capital, who is forcing others to buy its debt, and who is turning someone else's crisis into leverage for itself. Only when you ask the right questions do you begin to see the real board. If you have stayed with this to the end, then you may already understand why the world does not operate according to appearances. A war may look military on the surface, yet its core is energy. A retaliation may look diplomatic, yet its consequence is capital flow. And a crisis that seems distant can still end up changing fuel prices, interest rates, inflation, and the personal finances of millions of people far from the battlefield. The final question is not who will win one battle. The final question is whether, in the next 10 years, anyone can build a liquidity harbor large enough to compete with the United States, or an energy order stable enough to neutralize the leverage of major exporters. Until that happens, the world will continue living inside a system where chaos is not always an accident. For some, chaos is also a business model. And once you understand that, you will read the news differently, with less surprise, with less emotion, with greater composure in front of the daily theater of fire and smoke. Because in this era, the strongest actor is not always the one who fires the first shot. The strongest actor is the one who can remain seated, and still force the entire world to move by his rules.